The major US stock indices continue to rally for the second consecutive session on Thursday within our expectation as it managed to clear above various key moving averages due to the dissipation of the Trump tariff threats towards NATO/EU members. The US dollar continues to remain on a weaker footing due to this ongoing situation where the Fed is still looking to potentially continue its interest rate cut cycle into 2026. And yesterday's dollar weakness has been led by the risk-on proxy currency, which is the Aussie, followed by the Kiwi. However, due to this ongoing potential new world order that could has taken shape due to the episode where Trump starts to do a very forceful expansionary foreign policy towards US long-term airlines like the NATO members, allow gold and silver to surge to fresh all-time high yesterday. Very good morning to all and happy Friday. Welcome back to today's Daily Dose of Market Insights. I'm Kelvin here. So today will be Friday, the 23rd of January 2026. So before we jump straight into the gist of today's Daily Dose, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exit deposits. This presentation is for general information purposes and is not investment advice. Past information is not representative of future results. All right, so here we go. So very quickly, this is a disclaimer. So just now it was kind of hang for a while. Let me flash it up for a couple of seconds. All right, so let us start with what has taken shape yesterday as well as in today's early Asia session in terms of the relevant news flow and economic data releases. So let us start with the data releases first for yesterday. All right, so yesterday we have a couple of data releases that I want to share will be the US core PCE price index and as well as the initial jobless claim data. So let's start with the economic calendar. All right, so if we go down to the economic calendar on the continuous jobless claim, so it is almost within what market is expecting over here. So in terms of the weekly initial jobless claim, it came in at 200K jobless claim added. That means jobless claim is like people who are not employed and they seek for this kind of we call it putting away that a bit of what you call handouts from the US federal government. So the larger this number, it means that there is higher chance of a softer US labor market. But this number here is already rather erratic number because it's weekly basis. All right. So sometimes it could be distorted by seasonal factor as well. So market expecting 212K. It came in slightly below expectation, 200K, and almost on par with 199K initial jobless claim for the previous week. So this was for the week of 17th of January. So more in line within expectation. Okay, nothing much of a big surprise. And what's interesting here is that the core PCE price index year on year doesn't change pretty much. So it came in within expectation. So it didn't burst up to the 3% year on year level. So it came in within expectation at 2.8% for the month of November. So overall, market participants are still looking for the continuation of this ongoing interest rate cut cycle that kickstarted late last year. So the Fed did a 3 interest rate cut. So market is still pricing in at least 2 interest rate cuts so far based on yesterday's release of these 2 relevant economic data. One is the weekly initial jobless claim and as well as the core PCE price index, which is one of the favorite inflation trend metrics that Federal Reserve US Fed officials watches to gauge the inflationary trend in the US. So core PCE price index didn't spike up as feared, so that allows the Fed to potentially maintain its interest rate cut cycle, but not bringing it forward, but instead looking for in the months of June or July. So if you look at the CME Fed Watch 2, so market is still looking at a chance that the Fed will not do anything on next week. All right, 95% chance expecting the Fed to stand pat. So this is based on the price action trading behavior of the Fed funds futures trader in the Fed funds futures market. So if you look down the calendar over here under the aggregated tab, so market is still looking the 4th cut to come not in March and not in April this year, but rather to come on the summer months of the FOMC meeting. That means, i.e., 17th of June, 74% chance, which is quite high, where market participants is expecting the Fed to ignite the fourth interest rate cut in this ongoing interest rate cut cycle to bring it down to 3.25% and 3.5%. Let me enlarge this screen. And the next one potentially may be coming in on the last meeting of the year, which is 9th of December 2026, where we have a 73% chance of another 25 basis point cut to bring it down to 3% to 3.25%. So what is implying right now, based on the Fed Funds futures traders trading behavior, is market participants in the Fed Funds futures market is looking for at least 2 interest rate cut. All right, so that continues to maintain this ongoing interest rate cut cycle, which translate to further US dollar weakness after the technical breakdown of the key parallel ascending trend line previously I mentioned on Tuesday. So if you look at currently the US dollar index, so what you could see over here is that previously I do mention that the rally that has kickstarted during the Christmas breaks, the Christmas season or Christmas break from 24th of December all the way up to the recent high of 16th of January, which is last Friday. This rebound here is more like a dead cat bounce or a corrective rebound, where indeed price action shaped that bearish momentum on 20th of January, and after breaking down this ascending trend line support, now turns into a pullback resistance. Price action on Wednesday reacted to it and did a further bearish reaction on yesterday, Thursday, and by the end of the US session, it closed down below all the 3 key moving averages, which is the 50-day, the 200-day, and the 20-day moving averages. So overall, it's now looking back to trade down back towards this rather complex medium-term / major sideways range configuration that has taken shape since 1st of July last year. So the next 2 support level to watch on the multi-week perspective or medium-term perspective, it will be 97.7 followed by 97.2. So this will be on the US dollar index. So we know that US dollar index, we could use it as a gauge to actually decipher whether we are more skewing towards a dollar weakness or a dollar strength situation. So right now, it appears to us that based from a technical analysis perspective, and also like I share you guys in line with the US key relevant data that was released yesterday, and how does it impact the price action behavior of the Fed Funds futures traders, we call it price action behavior, net overall, potentially from a multi-week perspective, we are now potentially facing a US dollar weakness rather than a US dollar strength situation. So taking into account of the performance of the individual major US dollar pair over here, so what you could see is that this is the 5-day rolling performance. So very clearly, the dollar is the weakest against the Aussie and the Kiwi. So yesterday, why I explained why, because the Aussie dollar, that means the Aussie, 1 Aussie equals how many dollar, broke above various key resistance level on the shorter term basis, especially the 67.60. So that came in within our expectation as well. So the only one that is outlier right now will be the dollar yen. So dollar yen going to trade sideways, but can't break above the 158.50, 158.60 short-term neutrality range resistance that we highlighted yesterday, as this we call it this morning key risk event will be the release of the BOJ monetary policy decision and the outlook report. Later I'll come up more about that from here. All right, so this is the situation in the FX market right now. So if you look at the FX market as well for the dollar yen over here, so if you look at the economic calendar, let me refresh it. I think the decision, whether the decision is out yet from BOJ perspective on Friday. Okay, over here. Right, so if you look at the core inflation rate that was released earlier to today in Japan, so it came in within expectation. So market is expecting a slight dip to 2.4%. So it indeed came in within 2.4%. So, but still hovering above that 2% mark, where in the last, I think 3 to 4 years, where BOJ long-term desired interest rate, in order for the Japanese economy to say that we are no longer in a deflationary trend. So that has already been above, I think, 3 to 4 years back, above 2.4%. So if you look at the core inflation, so Japan is a bit weird. Core inflation only excluding, I think, energy. So if you exclude food and energy, they call it core inflation. So core inflation continues to remain high at 2.9%. So if you look at the trend of the core inflation over here in Japan, it continues to trade. If you go to the 5-year trend or even the 10-year trend, let's go to the 10-year trend. Okay, so it continues to trade above the 2% mark over here. All right. So representing that the Japanese economy is kind of no longer in a deflationary trend scenario that justified for this ongoing continuation of this gradual interest rate hike policy that's undertaken by BOJ since 2 years ago. But in between, there will be a lot of we call it noises in the dollar yen rate due to political influence by the current administration, who is much more of a favor towards expansionary policy. So other key Japanese data that is out, okay, so the interest rate is out already. I'm going to share it will be the flash PMI data out from Japan. So flash PMI data is considered as a tier 1 leading economic indicator, not only for Japan and the rest of the other countries as well, being said that it's a sentiment survey-based data. So anything that's sentiment survey-based data tends to lead ahead of hard data. So based on the services PMI data, services industry purchasing manager continues to sound very pretty much optimistic about the state of the Japanese economy, or in the state of the services industry in Japan, where it rose to 53.4 from 51.6 in December. And also what's interesting is that the manufacturing continues to PMI Japan manufacturing PMI flash data for January continue to expand at a 10-bit pace. Previously, it was at 50, it expanded to 51.5. So indicating that those purchasing managers that S&P Global surveyed in their this PMI data, both on the manufacturing side of the story and the services side of the story, continues to remain optimistic about the state of the Japanese economy. So net overall, that potentially also allow us to actually reinforce that bullish bias trend that we have in the Japan 225 that we have 2 days ago. Right, so BOJ interest rate unchanged at 0.75%. All right, so let me share with you what is their outlook report over here. Give me a minute. So let me refresh to this investing.com. So they are pretty investinglife.com. So they are pretty fast in picking up data. So since okay, so hold it as expected. So let me see, did they mention anything about the outlook report? So it's a widely expected, no big change over here. Okay, so it appears that the outlook report is not yet out. So later we'll come back more about that over here. All right. So let me move on. That will be the FX market. So over at the stock market perspective over here, yesterday we continue to see a bullish performance in the major US stock indices. So all 4 of them closed almost on par. The Russell 2000 positive 0.76%. The Dow Jones 0.63%, the Nasdaq 0.76%, the S&P 0.55%. So almost on the same footing. I mean, we don't see a stark outperformer among the major US stock indices yesterday, but most importantly, all of them continue to shape bounces after that so-called tariff trade by Trump got dissipated towards NATO/EU members. So right now, yesterday, there's some details coming up from that so-called framework Greenland deal as touted by US President Trump in the previous day, which has been reached. So there's this news flow report. Let me expand it. So Trump mentioned that right now, US will have total access to Greenland over here. All right, total access to Greenland. But this total access to Greenland doesn't discuss about the sovereignty of Greenland. Okay, so total access means that US firms is able to actually, and defense military manage to station their relevant key resources in Greenland. So over here, there's a Bloomberg report stating that now with this framework deal that is in place, let me expand. Okay, so what does it mean? So the deal between US President Trump and NATO Secretary General Mark Rutte paves the way for NATO to beef up security in the Arctic region to fend off any threat from Russia or China. So the framework entails stationing of US missiles, that means US key assets, missiles, defense assets, mining rights. So mining rights will be granted to US corporation aimed at keeping Chinese interests out, and a boasted NATO presence, according to a European officer brief on the talks. However, the issue of sovereignty was not on the table. That means so far right now, this framework deal doesn't include Denmark transferring Greenland ownership to US. Then basically, if you go down the news flow, that will be the further detail. Yeah, over here. So Trump's framework agreement to Greenland changes to the 1951 treaty to guarantee US military base requirement. This is about the same, strengthen NATO and high North security. It will include a multinational NATO command in Greenland under US command. So right now, NATO military assets stationed in Greenland will come directly under the command of US. So that's what I mean by total access by Trump. That means total US military can get total access in Greenland for strategic and security reasons, where NATO troops stationed in Greenland will be under the orders of the US military. All right. So then the next part will be an economic component will be to be negotiated, including mining rights. So this is pretty much interesting. So mining rights, it will be the right for US corporation to mine out assets, and thereafter this asset would potentially belong to US rather than Denmark, whatever thing that is being dug out underneath the ice. And the key thing is measures to stop Russia and Chinese economic and military presence on Greenland. And most importantly, this part here, US stops threatening tariffs on Europe. So that created the positive feedback loop in the major US stock indices that has kickstarted on Wednesday, extending into Thursday. So then with this very interesting mining rights that the US corporation have, if you look at the S&P performance, right now we see a continuing outperformance of the one particular sector that is concentrated on the mining business. So let me share with you what is this. Okay, so this is the heat map of the S&P 500 yesterday. So if we break down the heat map according to the groups of the 11 sector of the S&P, so basic material yesterday outperformed by 1.2%. So this basic material is considered of US corporation that does mining. So with this mining capabilities, where US corporation have the right to gain strategic resources, that is whatever that is being dug out from Greenland ice underneath belongs to the state of US, and most importantly, US company will have a much more business opportunity overseas, given that right now there's a kind of a feedback loop saying that US now is looking for other places to potentially extract resources that is deemed as strategic resources and from a security perspective. So in order to do that, I got to deploy my US corporation to do it rather than relying on other international corporation. Okay, so that's why basic materials is outperforming yesterday, 1.2%, and for the week is the top outperformer, 3.25%, way ahead of the mega cap technology stocks, which is only in the technology sector, which is still down negative 0.45% as a whole, right? So there is now this kind of sector rotation, which I explained to you guys earlier at the start of the year, is unfolding, and this unfolding is getting much more clearer. So previously, those mega cap technology stocks that is high flying and outperforming the broader US market due to the AI optimism team play is now taking a backseat. And now traditionally old economy stock, like stocks that deals with mining, stocks that deals with energy, stock that deals with industrial, and in some form the financials, due to the continue of the steepening of the curve and the yield curve, this potentially could continues to outperform the broader US stock market. And these guys are much more heavily weighted in the Dow Jones Industrial Average. All right. So that's why we see lagging underperformance of the Nasdaq 100 so far this year. And also the Russell 2000 small cap company is due to Trump's policy of reducing mortgage rates, allowing credit card interest rate to be as low as 10%. So that also created a boom for the Russell 2000 company, which pretty much reliant on leverage, or we call it play with that either financial leverage or fixed income, a fixed asset leverage to drive their bottom line. All right, so that is the situation right now that is taking shape in the US stock market. All right, pretty much explained to that. All right, over here. So before that, let me confirm that everything is working fine before we continue. All right. Let me see. Okay, let me just do a check on my screen. I think should be fine, right? Just do a check again. I think should be all good. Okay, so let us continue, right? Let us now touch on the second segment. Okay, before going to the second segment, let's see whether the any snippets on the outlook report from BOJ. Okay, that means. Oh yeah, this is the one. Very interesting, huh? Okay, so basically, it continued to lift the core inflation outlook report. Descent highlights inflation risk. That means it seems to us now that the BOJ officials right now are pretty much concerned about inflationary pressure rather than the concern about the volatility of the JGB longer term bond yields. The 30 years spiking to fresh all-time high this week. That's created a bit of fiasco to the Japanese economy. So they didn't mention about concern about that, but more concern about the direct we call it economic situation right now, and it leaves the core inflation outlook. So let me go further down over here. So there's one guy dissented, calling for an immediate hike to 1%. That's 25 basis point. So core inflation forecast revised higher across the fiscal year. And even they also upgraded the growth for financial year 2025 and financial year 2026. So the net overall impact, okay, so basically the median forecast for fiscal year 2025 rose from 3% from 2.8. So basically across the board revision upward for core inflation. For fiscal year 2026, so that will be this year, 2.2% from 2%. And from the longer term fiscal year 2027 rose from 2.1% to 2%. And also upgraded the growth for real GDP growth forecast from 0.9% and 1% respectively for fiscal year 2025 and 2026. That means this year and this coming year as well, from 0.6% previously. So 0.7% previously, pardon me. So fiscal year 2027 real GDP growth forecast was trimmed slightly to 0.8% from 1%. So expecting maybe perhaps due to the gradual interest rate hike policy that could suck up a bit of growth in the later part of the in one more year from now, which is fiscal year 2026. But that's not really a major downgrade of economic growth. So just 2 basis points to 0.8% over here. So that's now take a look at the situation now in the FX market on the intraday technical outlook perspective. All right. So, okay, I think everything is good. Okay, so let us now proceed. Okay, so let me expand my screen and let us kickstart with the intraday technical outlook on the FX market first. Okay, so let's start with the FX market over here with the euro dollar. Okay, give me a minute. Let me adjust the screen. Okay, so let's start with the euro dollar. So euro dollar bounced up as expected from our pivotal support yesterday and cleared above our first resistance at 117 figure level within our expectation and almost hit the second resistance at 117.65. So yesterday it printed a intraday high of 117.59. All right, give or take is about in line with our expectation. So right now the RSI has now managed to exit from the overbought level over here. So while exiting from the overbought level, there is no bearish divergence as price action shaped a higher high in line with the price action that was being seen yesterday. So more of a minor pullback rather than the start of a much more drastic, deeper corrective pullback. So with that being said over here, I will actually now use a tightened pivotal support for today, which is the 117 figure level. Yesterday, first intermediate resistance now turns to a pullback support that also confluence with the 20-day moving average as well, making it as an important short-term inflection level where the bulls may step in again to shape another rebound on the euro dollar. So therefore, be bullish on any pullback, minor pullback, as long as 1.17 figure level holds on the euro dollar. First resistance level to watch out for today on the intraday perspective, 117.65, followed by 117.90, 118 figure level, which confluence with the key minor swing high area of 16th of December and 24th of December. However, a bearish breakdown below 117 figure level will invalidate the direct bullish buyer's view on the euro dollar to see again another round of much more deeper corrective pullback to retest 116.60, 116.45 on the intraday basis, which correspond to the rising 50-day moving average. So that's for the euro dollar. Next up will be the sterling pound. So the sterling pound is that I mentioned that do keep a lookout for this ongoing bullish minor bottoming formation that has already formed, where it managed to hold above the 200-day moving average and also start to form this inverse head and shoulder bullish formation, where this is the head, this is the right inverse shoulder, this is the left inverse shoulder, and it now managed to clear above the neckline of the resistance of this bullish minor bullish inverse head and shoulder formation. So with that, I were able to tighten my pivotal support level to a slightly higher level today, which is Wednesday minor swing high, and Thursday minor swing high, where it got this bullish breakout and also confluence with this 20-day moving average, all coming in at 134.50. So as long as any minor pullback didn't surpass below 134.50, we will continue to maintain our bullish bias on the sterling dollar, as it's now shaping this bullish bottoming formation breakout, with the next resistance coming in at 135.50, 135.80 in the first step, which is the upper limit of this medium-term ascending channel from the low of 5th of November as well. However, a bearish breakdown below 134.50 with an hourly close below it, that would negate today's bullish bias view to see a deeper slide to retest the important 200-day moving average that is confluencing with the yesterday's minor swing low and Wednesday minor swing low at 134.05 over here. So that's for the sterling dollar. Next up will be the Asia Pacific currency over here, which is the high flying Aussie dollars. All right, starting first. So the Aussie dollar rallied as expected and hit our resistance level at 68.30, 68.45. So right now, the RSI has really exited from the overbought level as we are speaking right now at 11:30 a.m. Singapore time. But prior to the exit of this overbought level, it does not flash out a bearish divergence, so indicating that it may shape only a minor pullback rather a much more steepened minor corrective pullback. So with that, I will tighten my pivotal support level to 0.68 figure level, but however, I cannot be outright bullish right now, so there could be a deep down taking shape of the Aussie dollar due to the current exit of its overbought level right now at 11:31 a.m. Singapore time. So with that, I will be bullish on any minor corrective pullback as long as it doesn't break below 0.68 figure level, tighten short-term pivotal support level for today. The next resistance level to watch out will be 68.80, 69 figure level, which is a bunch of Fibo extension level, and as well as the upper limit of this ongoing kind of a expanding wedge sideways range configuration drawn from the high of 7th of May, this dotted gray line over here. So back to the hourly chart. Only a bearish breakdown and an hourly close below 68 figure level that will invalidate our direct bullish scenario on the Aussie dollar to kickstart another round of steepen deeper minor corrective decline scenario back down towards 67.60/67.44. So with the price action coming down back towards 67.60, 67.44, I'll be on the lookout for a bullish reversal candlestick again, because overall the medium term and the short term trend on the Aussie dollar continues to remain intact. So any deeper minor corrective pullback will still be skewing towards the bias for a bullish scenario rather than the start of a potential medium-term corrective decline phase for the Aussie dollar. All right, so that's for the Aussie dollar. Lastly will be the dollar yen. So the dollar yen continues to churn. It's still within our neutrality range, so-called zone. Given the fact that we still have another risk event coming in, which will be the Bank of Japan governor press conference later. So with that, I will stick to a neutrality stance for now, 158.85, 157.50 for now. All right, so only a sudden push up above 158.85, then potentially it may squeeze up towards 159.45/159.75, followed by 160.25, 160.35. So once it comes to this level over here, bear in mind that it's the intervention zone. Okay, so let's go to the daily chart. So previously it intervened over here during 160.25, 160.23, 26th of April 2024. There's a BOJ intervention, and on 12th of July, where he hit the intraday high of 159.45, BOJ intervened again on 12th of July. Right. So as long as it comes into this area here, there is a risk of intervention. Risk is getting heightened due to the previous behavior by BOJ, where they intervened in the past. One price hit these levels. All right, so something to look out for as this next risk event takes shape, which is the Bank of Japan governor. Let me highlight it in press conference later at 16:30 GMT time. So we are 8 hours ahead. So that will be 2:30 p.m. Singapore time. So something to take note of if we have an interest in the dollar yet. All right, so that sum up the FX market situation on the intraday basis. So let us now take a look at the major major stock indices. All right, over here. So starting with the Hong Kong 33. Okay, so the Hong Kong 33 squeezed up as expected and hit our first two resistance level at 26,670, 26,870, now shipping a minor pullback over here. So with that, I would now tighten my pivotal support level slightly higher. Okay, let me adjust it back down to this range here, which is the lower limit of this minor ascending channel that is in place since 16th of December this year. Last year, 16th of December last year, pardon me. So that will be at 26,480. So I shift it from 26,330, 26,250 to 26,480. All right, let me put it in 26,480. Okay, let me shift it down to here. 26,480. Let me change this. 480. All right. Oops, sorry. Okay, let me delete. Come on, delete this. And using today's Asia opening session high, swing high area. So that will be my first intermediate resistance. Okay, this zone here at 26,922. 26,922. All right, so tally up everything. So maintain my bullish bias on the Hong Kong 33. That is representing the Hang Seng Index with a slightly adjusted upward pivotal support level at 26,480. First resistance level to watch will be 26,922, followed by the stiff minor range resistance that has been in place since 13th of January to 16th of January this year at 27,175 on an intraday basis. However, a bearish breakdown below 26,480 will see a deeper minor corrective pullback unfolding towards 26,330 again, 26,250. Failure to hold above 26,250 may see further weakness to retest the 50-day moving average, and as well as the dotted gray line here, which is the former double bottom neckline resistance, now turns into a critical pullback support, all confluencing at this zone of 26,045, 26,590. All right, so that's for the Hong Kong 33. Next up will be the Japan 225, that is representing the Nikkei 225. So the Japan 225 squeeze up as expected, hit the resistance level at 53,790 or so, this level here. Okay, 53,787 or 790, round it up. So now turns into a pullback support, and indeed exposed BOJ monetary policy decision after that, and also exposed release of the BOJ quarterly outlook report. Price action managed to hover very steadily at this 53,787, but I don't want to tighten it, my pivotal support to be so tight at 53,787 due to the fact that we have BOJ governor press conference later at 2:30 p.m. Singapore time, and also price action hasn't broken up above our current all-time high level. Also the resistance level at 54,565, which I highlighted yesterday. I will only able to tighten my pivotal support from 52,640 towards slightly higher to this former minor swing high area where it did a sell off. The former minor swing high area on 22nd of January also did a sell off before shaping that bullish breakout, now turns into a pullback support level. And if you do the Fibonacci retracement of this ongoing bullish impulsive upmove sequence from the low of this Wednesday all the way up to yesterday's US session high, that also confluence with the 50% Fibonacci retracement very closely. So with that, adjusted it slightly upwards to 53,100. So that will be my pivotal support level for today. Still maintain that bullish bias. Two resistance level to watch out for on the intraday basis for today: 54,565, 54,910, 55,050. So unless it has a clearance and an hourly close thereafter above 54,565, then I will tighten my pivotal support to 53,787. However, a bearish breakdown below 53,100 and the hourly close below it will negate today's bullish bias view to see we call it a much more deeper minor corrective pullback to revisit 52,640 slash 52,437, which is a confluence with the 20-day moving average as well. Okay, let me slash it. 52,640 slash 437. Yeah, 437. So once price action revisit this zone over here, which is also the pullback line of this former descending trendline resistance that was previously in place since 15th of January and stage a bullish breakout on 22nd of January, turns into a critical near-term support level. So once price level hit this level here again, 52,640, 52,435, 437, I'll be on a bullish bias to have a lookout for any bullish reversal candlestick to shift the owners back into a bullish stance again, given that the medium term and the short term uptrend phase of the Japan 225 remains intact. All right, so that's for the Japan 225. Next up will be the Germany 30, which represent the German DAX. So the Germany 30 managed to squeeze up on Wednesday, but traded sideways in kind of a bullish continuation pennant formation. Can't break above the 20-day moving average and the former medium-term ascending support that was drawn from the 21st of November 2025 low. Now this is the pullback resistance, confluencing at 24,970. But RSI continues to now shape a bounce off from a former parallel descending trend line. Now turns into a pullback resistance, former parallel descending trend line now turns into a pullback support level where price action now shaping a bounce and forming a higher low. So indicating that the bullish momentum remains intact. But however, I do not want to tighten my pivotal support level to be so tight at 24,700 today over here. So let's round this up, 24,700. Because price action is still trading below yesterday's session high at 24,970, and we see a stubborn kind of minor resistance over here. So unless we have a bullish breakout above 24,970, then I will tighten my pivotal support to 24,700. So still remains on a bullish bias, but on the lookout for the bullish break of 24,970 before I could tighten my pivotal support to 24,700. So far, pivotal support still remains this key bullish reversal swing low area of Wednesday, 24,480, 24,375. Next two resistance level to watch will be the gap down resistance that has been formed on Monday, 25,081, followed by 25,260 for today. If we start to see a very strong bullish move during the European session, clearing above 25,260, then we are able to see a retest of the current all-time high area that was formed on 13th of January at 25,505. Only a sudden bearish reversal breakdown below 24,375 that would invalidate today's bullish bias view to see a retest on the 50-day moving average in the first step at 24,250. Failure to hold above 24,250 will see the deeper minor corrective pullback unfolding to test the key 200-day moving average at 23,885. We also confluence with the key 18th of December minor swing low area that kickstarted the prior strong bullish impulsive up move from 18th of December all the way to 13th of January previously. So that's for the Germany 30. Next up, the major US stock indices, starting with the US Wall Street 30. So US Wall Street 30 almost hit the fresh all-time high, being the one of the strongest performing major US stock indices, ahead of the S&P 500 and also way ahead of the Nasdaq 100 that is still about 2% plus from its all-time high that was printed in October last year. So yesterday it retests the current all-time high, can't break it, but come down and now managed to see some form of a rebound taking shape at the intermediate support level at 49,350. So I would for now tighten my pivotal support level for 48,770, 48,650 to 49,000 figure level, which converges with the 20-day moving average. So if later during the US session is able to have a clearance and the hourly close above this 49,606, then I will tighten the pivotal support to 49,350. So for now, adjusted upwards slightly to 49,000 figure level, short-term pivotal support on the US Wall Street 30 that's representing the Dow Jones Industrial Average still continues to maintain that bullish bias for it to seek out a new fresh all-time high above 49,606 in first step will come in at 49,805 slash 840. A strong clearance above 49,840 will expose the next intermediate resistance zone at 50,144 slash 50,265, which is a Fibo extension level, cluster level. And based on the latest impulsive upmove sequence, this level here could be found at the 1 time and the 1.236, right, very closely, and also the upper limit of this medium-term ascending channel from the low of 23rd of May 2025 that is still ongoing. However, if we start to see a sudden bearish reversal and hourly close below 49,000, that would invalidate the direct push-up scenario for the US Wall Street 30 to see it drifting downwards again for another minor corrective decline sequence unfolding to retest 48,770/750 maximum, the key bullish reversal low of Wednesday, where Trump reduced back his rhetoric towards the tariff threats that he wanted to impose on NATO members, which is 48,480, 48,340. Right, so that's for the Nasdaq 100. Next up will be the SPX. So the SPX still can't hit the fresh all-time high, which was around the 7,000 level, 7,005, that was previously printed on last Tuesday, 13th of January. So given say that it hit our resistance level, 6,945, before trading a minor pullback and now try to inch back up above the 220-day moving average. So first support level to watch out for today will be yesterday's swing low area here during the start of the US session, which is at 6,908. All right, so for now, pivotal support will be tightened up towards 6,877, maintain that bullish bias on the SPX 500, a clearance above 6,945, and the hourly close above it during the US session. I will tighten my pivotal support to 6,908, with the next resistance coming in at 7,705, which is the current all-time high area. However, a bearish breakdown below 6,877 will invalidate today's direct push-up scenario and see another round of choppy minor corrective pullback unfolding to revisit 6,830, 6,810, maximum 6,744. So that's for the SPX. Lastly will be the Nasdaq 100. So Nasdaq 100 also managed to squeeze up, hasn't hit the stiff resistance level again, range resistance that has been in place since 8th of December, where it can't broke above it last week as well. So continue to maintain that bullish bias on the Nasdaq 100, a mild bullish bias unless it has a clearance above 6,830, then we could see a much more strong full move upwards towards 2,107 before the current all-time high that is still way below it at 26,290, which was printed previously in the month of 30th of October last year. So for now, two key resistance level to watch on the intraday basis: the intermediate support level 25,489, with my short-term pivotal support tightened it to 25,350, which confluence with the 50-day moving average. Maintain that bullish bias on the Nasdaq 100. First resistance it got to clear will be the stiff range resistance level of 25,760, 25,830 for today. However, a bearish breakdown below 25,350 will negate this direct push up and see another round of choppy minor corrective decline sequence unfolding towards 25,105, 25,030, maximum 24,870. All right, so that sum up the intraday technical outlook on all these major stock indices. So let us now touch on the commodities market, looking at the gold XAU/USD. So gold X, oops, sorry, let me expand the screen. So gold XAU/USD continue to pierce upward and cleared above our first resistance level, 49,015, 49,937. All right. The second resistance. Well, yesterday we have two resistance. One is at 4,878. That was the prior all-time high. Second resistance 4,915, 4,930. So RSI continues to remain bullish over here. So continues to expect this bullish acceleration phase for gold XAU/USD to play out further. So right now, so this will be a pullback support level. Okay, let me delete this. Okay, to watch. So given that, so this will be a pullback support zone, 4,937, 4,878, the current all-time high over here. So given that now it's coming very close to the psychological level of 5,000, 5,005, and also a bunch of Fibo extension cluster level, but no bearish exhaustion sign that's being seen yet on the hourly RSI. There's no bearish divergence, right? Still shape a higher high over here in line with the higher high that's being seen on the price action on the raw price action on the hourly chart. So with that, my pivotal support, I will title it to yesterday, Wednesday minus swing low, and yesterday Asia session swing low, where exactly this is the tipping point where it managed to shape that minor intraday bullish impulsive up move. So that will be at 4,775. So unless we have a clearance and the hourly close above 5,505, that I will tighten my pivotal support to the current or the previously all-time high, now turns into a pullback support at 4,878. All right, for now. Next resistance level to watch after 5,505 will be at 5,094, 5,149 in first step on the intraday basis, using a slightly adjusted upward pivotal support to 4,077 for now. Okay, 4,775 for now. If we have an hourly close above 5,005, then I will tighten the pivotal support from 4,775 to 4,878. So right now it's at 11:49 a.m. Singapore time. However, a bearish breakdown below 4,775 will invalidate today's direct push-up scenario to see a corrective pullback scenario unfolding again within this short-term uptrend phase as it's still trading above the 20-day moving average to expose the next two near-term support level, 4,684, 4,687, maximum 4,645, 4,600. So once it hit this zone of support level, I will be still on the lookout for a bullish bias basis for a bullish reversal candle, given that its short-term uptrend phase is still remains intact as it's going to trade above the rising 20-day moving average. So that's for gold XAU/USD. Lastly will be the West Texas crude oil over here. Okay, let me expand my screen. So the West Texas crude oil, come on. Yes. So the West Texas crude oil, as expected, it can't break above the short-term pivotal resistance level that we highlighted, 61.17, 61.35, and shape that desired pullback before shaping a minor bounce in yesterday US session. So still continues to maintain a bearish bias using 61.17, 61.35 as you're going to trade in a very choppy sideways range configuration. Breakdown below 58.76, which confluence with the rising 50-day and the 20-day moving average, will expose the next near-term support level at 57.74 for today on the intraday basis. Only a bullish breakout and an hourly close above 61.35 will invalidate our bearish bias within a complex sideways range scenario to see a further squeeze up towards the key 200-day moving average that is confluencing with the next intermediate resistance zone at 62.45/63 figure level. All right, so that sum up all the intraday technical outlook on the broad-based cross asset classes. So before we go, let's have a quick look at the economic calendar/events. What are the data to look out for? So up and coming data or event, like I mentioned earlier on, will be the Bank of Japan Governor Uda press conference that is to be held at 6:30 0630 hours GMT time. So we are 8 hours ahead of GMT time. So that will be at 2:30 p.m. Singapore time. All right, over here, all right, 2:30 p.m. Singapore time. Then other calendar to take a note will be other global PMI services flash data for January that will be releases across the board for the entire developed nations. But prior to that, we have UK retail sales at 3 p.m. Singapore time today for the month of December. So market expecting a slight improvement to 1%. So if it goes beyond market expectation, that could allow a firmer sterling dollar and the sterling crosses. So something to take note of. That will be 3 p.m. Singapore time. Then thereafter, you have this slew of flash PMI data that's being released across the Eurozone. From France at 4:15 p.m. and Germany, the key one, manufacturing and services at 4:30 p.m. and followed by the aggregated Eurozone manufacturing PMI and services PMI flash data for January. So all this period between 4:30 to 5 p.m. that could influence the rate of the euro dollar, the euro crosses, and as well as the Germany 30 CFD. Then thereafter, half an hour later, 5:30 p.m., we have the UK global services flash manufacturing PMI and services PMI to be released, so that could influence the UK 100 CFD index, the sterling crosses, and the sterling against the USD, the pound. And we have a BOE official speaking, Green, she was speaking at 5:30 p.m. as well, followed by 6 p.m. ECB President Lagarde speech. Then before we start the US, after 15 minutes after the US session get kickstarted, we have 10:45 p.m. The manufacturing PMI data compiled by S&P Global. Both for the manufacturing and services will be released at 10:45 p.m. Flash data for January, so that could influence the major stock indices as well, and in some form the major dollar pair. And thereafter, we will have a rather quiet US session over here. All right. So with that, that sum up today's Daily Dose of Market Insights. I'm Kelvin here. Do have a great and restful weekend, and we shall speak again on Monday. Thank you.